Nifty could even see 24,500 by the end of this year. The rally in India, while to some extent is driven by economic growth and corporate earnings doing well, there is a possibility that India will kickstart several reforms. These reforms are in order to achieve the stated economic goal of the government to become a developed economy by 2047. India is a very strong growth story, and there's a lot of money to be made from a next 5, 6, 7 year perspective.
印度股市连创新高，目前已经成为全球第4大市场，并且这个牛市已经维持了超过20年的时间。那么，印度股市20年长牛原因何在？今天我们请到一位印度专家来解读。Mr. Amish, thanks for joining me.
Absolutely, my pleasure. Thanks for hosting me.
The performance of India's stock market has attracted global attention. It has continuously hit new highs and become world's 4th largest stock market. For the past 20 years, the market has risen 20 times. So first of all, what created the 20-year bull in India?
Sure. If you look at it, India has seen multiple reforms, which has resulted in a very strong and a stable macro environment. It has also resulted in a very healthy financial sector as well as strong private sector balance sheets. And there is an exponential increase in the physical infrastructure as well as the digital infrastructure that India has created. All of these factors, when you combine together, we have seen an economic outcome resulting in around 10% nominal GDP growth per annum on an average over the last 10 years, which then has supported the 13% average returns that we've seen in the stock markets in India. More importantly, we think that these factors have now created an environment where there is a possibility of creating multi-year upcycles for real estate upcycle, infrastructure capex upcycle, the startup ecosystem upcycle. And generally, when these upcycles come together, it leads to very strong economic growth over a very long period of time.
You believe the market will continue to do well in 2024, giving a target of Nifty 50 at 23,000. So where will the momentum come from?
The Nifty target of 23,000, you're very right, is our base case. We also think that if some assumptions which are slightly optimistic, but the probability of which to play out is reasonably high, if these assumptions play out, we think that Nifty could even see 24,500 by the end of this year. Now, one of the most important assumptions is that after the elections in India, which are scheduled in the May of this year, there is a possibility that India will kickstart several reforms. These reforms are in order to achieve the stated economic goal of the government to become a developed economy by 2047. And then clearly, if these reforms are enacted, we think it will provide visibility for long-term economic and corporate earnings growth, which can support the markets. Largely the rally in India, while to some extent is driven by economic growth and corporate earnings doing well, it is also equally supported by very strong liquidity or inflows that we've seen from domestic investors into markets. And that as a trend we think will continue because a large part of this flows is now driven by passive flows, which will come into the market. And finally, I would argue that as we expect that the Fed in the US will start cutting rates by June this year. If that were to happen, that could also lead to a revival of foreign investor inflow into Indian markets versus the outflows that we've seen so far.
But do the fundamentals of India's stock market hold up in the long term?
As I'm saying that, the economic environment is very stable and it is pro-growth. India has very well controlled its inflation and forex. We are also in the process of consolidating our fiscal deficit and current account deficit. So it's a very good setup from a macro perspective, for India to propel its economic growth going forward. And one of the incremental factors that we are looking out for is if the reform momentum were to start post-elections. If that were to happen, that will provide a visibility for very long-term sustained economic growth, which will then help support equity markets as well.
Let's talk about valuations. The Indian stock market has become one of the world's most expensive ones. The 12-month forward P ratio of the market is almost the same as S&P 500. Is this a problem for you?
Sure. So on valuations, you are very right that when I look at the broader markets, including the mid and small cap stocks, the valuations there clearly look stretched, and therefore we think that the mid and small caps can see a correction. However, when I look at the large cap index like Nifty, that is still trading at 21 times 1 year forward earnings, which is only 10% more expensive than its long-term average. And given the narrative that I was mentioning that India's economic growth can be higher for very long term, and with a very clear vision of the government that they want to have India become a developed economy by 2047, and has a very clear plan to go towards there. So on the back of a very strong macro supported by a very strong vision that can lead to stronger economic growth for long term, we do believe that valuations can be higher than the long term averages over a long period of time in India, and therefore the valuations has the potential to continue to expand. But even today, even within Nifty, there is 30% of the Nifty's market cap, which is still trading below long-term average, which creates pockets of opportunities for investors to buy. And as a result, to conclude, I think the large cap index clearly has pockets of opportunity and continue to do well. The mid and small caps is where the valuations do appear stretched, and that is where we do expect a correction.
So you are very optimistic about the market. Then what should we invest in 2024? And what sectors do you prefer?
Generally our preference is to own domestic cyclicals as opposed to global plays, because clearly India is doing much better in the context of the world right now, and therefore domestic cyclicals we think will outperform. Similarly, if you are looking for a good economic growth outcome going forward, then we are preferring growth stocks over defensives. And from a valuation perspective, right now we prefer large caps over the mid and small caps. So a combination of these factors, and then overlaying that with the matrix of where we are seeing earnings growth, stability or visibility of earnings growth, investor positioning. We are overweight on the financials, industrials, cement, and the autos sector, whereas we are underweight on the IT, materials, energy, utilities, telecom, and the healthcare sectors. So financials and industrials sectors tops my list right now, because these are cyclical sectors. But what we've seen is that when the cycle turns favorable, generally the cycle goes on for 10 years. And we currently think that we are only in the third year of a 10-year upcycle. So there's a long runway for growth, for these sectors. Just to give you a perspective, credit growth, during the previous upcycle used to be 17%, and then it came down to 11, and we are again going on the way back up. Similarly, if you look at the industrial sector, during the upcycle of 2003 to 2013, we had seen earnings growth come down to 3%. But during the upcycle, this is a sector that delivered 30% earnings growth. So 3 to 30 is clearly a sign of this being a very deep cyclical sector. And we do think that we are in the process where that 3 to 30 story will play out for the industrial sector as well. So financials followed by industrials as sectors are the sectors that we are most excited about. The other sectors like cement, autos, they are short cycle sectors. So there we think that for some time will be positive. Once the valuations have already caught up, maybe there will be some other sectors which will become more exciting over time.
At last, is there anything else you would like to say to foreign investors?
Maybe it is paying up a little bit of higher valuations in the near term, but India is a very strong growth story, and there's a lot of money to be made from a next 5, 6, 7 year perspective. And then I say this particularly because as of now, whether I look at FII ownership of India, it's at a multi-year low. So just to give you a number, back in the December of 2021, FIIs used to own 21.5% of Indian equities. They today own 18.5% of Indian equities, which is at a multi-year low. Similarly, back in December of 21, FIIs used to be 120 basis points overweight on India. Currently, they are neutral weight on India. So even their positioning on India within the EMs is at a multi-year low. So given that they are sitting at the multi-year lows, and we are constantly seeing outflows from FIIs, it seems that they are worried about the valuations near term. But probably I would argue that they are better off looking at the growth prospects over long term.